Hello and welcome to the next of our lecture recaps. This is a recap of our lecture on approaches to corporate governance. So the two main types of approach that we can take to corporate governance are first of all rules-based. Now rules-based is an example in the US and that is under the Sarbanes-Oxley Act, which we look at in a bit more detail in a second. So what we can do is we can set rules. Those rules are binding, those rules can't be changed, and therefore you need to apply all of those rules in full. So why would you want to do that? Well, you would do it for clarity to ensure that everyone knows what they need to do, for standardization so that everybody has the same set of rules. You would make sure that they're binding so there was no choice, you had to do it. Also, you would make sure that that was a deterrent to carrying out a fraudulent behaviour, for example. And all of that would increase the confidence of the users in the financial statements because we've got those rules in place. As opposed to a principles-based code. Now this is the UK code that we've been talking about. So the UK Corporate Governance Code is comply or explain why not. So we comply with the principles or we explain why we haven't in our annual report. So rather than having a set of rules that are binding and there are deterrents in place such as fines if you don't apply them, it's a set of principles and the theory is that if you don't comply, you explain why you haven't done so. So why would you do principles rather than rules? Well, it does reduce the loopholes in place. So it ensures that if there's a rule and we can get around that rule, well, that's picked up by the principle. It's not just box ticking in that respect. You have a set of principles. If what you're thinking about doesn't apply with the principles, well then you cannot do it. So it's therefore going to be more flexible. That also means that it's going to be cheaper to comply with. So those are the two types of approaches, rules-based, for example in the US, and principles-based, for example in the UK. So looking at a bit more detail at our Sarbanes-Oxley Act, which is in the US, this, remember, was a response to Enron and WorldCom. So those were two corporate collapses that really stemmed from a lack of corporate governance. So what is Sarbanes-Oxley? It's a piece of legislation that carries out the rules for governance. It's detailed and it's legal, so you have to apply it. And the Securities and Exchange Commission issues these rules so that anyone who's listed in the US, or indeed anyone who is a subsidiary of a US listed firm, must apply the Sarbanes-Oxley rules. So some of the requirements that there are, first of all, the CEO and CFO must sign off on the financial statements' accuracy. If they are subsequently restated, so there was a mistake in the accounts, and that's through non-compliance with Sarbanes-Oxley or another code, well then the CEO and CFO forfeit for their bonuses on that basis. So they don't get their bonuses, they have to pay them back if the accounts are restated. Also, there are restrictions on the auditors doing non-audit work. Again, that's because Andersons, the auditors of Enron, were complicit in the fraudulent behaviour. Audit partner rotation after 5 years is required under Sarbanes-Oxley, and there are restrictions on off-balance sheet transactions. Section 404 in particular says that we have to give a statement on internal controls by the directors, so they need to actually state that they are responsible and who is responsible for the internal controls. So they need to disclose how effective the internal controls are, if there are any weaknesses they're aware of, and those internal controls need to be audited. So the impact of Sarbanes-Oxley has been, first of all, the results are that the directors are personally responsible. So that is going to improve the controls and the audit because they need to sign off and they need to give that statement on internal controls. That is increasing the confidence in the financial statements, and definitely there has been an improvement in governance. However, there have been some problems. There's costly documentation to put in place. It has led to increased audit fees, and it is much less flexible than a principles-based code. Also, some have argued that it actually has limited impact on reducing the amount of fraudulent behaviour. So that's Sarbanes-Oxley. Make sure you're aware of all of those areas. Just to make a note that the structure of the firm will have a big impact on what the approach to corporate governance should be. So the governance of the organisation will often depend on the structure. So thinking about a couple of different structures other than the shareholder management relationship, we could have a family structure where the family has a controlling interest in the business. So what does that mean in terms of governance? Well, the agency costs will be reduced because the family will be working within the business. It also enables the business to take a longer term view because they can accept decisions that don't act in the short term. And they may well take a more ethical view because that family is involved. However, that business will rely on the family having the ability to run it, and it may well lead to family feuds, which is not good for the business. Another type of business structure you need to be aware of is insider dominated. That means we have small groups of shareholders. So that may be similar to a family structure because the family in that case were the ones who had the groups of shares. In this case, we have small groups of shareholders, and that has similar benefits to that family structure. So we don't have lots and lots of different shareholders. However, we do get less transparency because those shareholders don't need to reveal the information. It may mean that there's less market impact, and there may well be an abuse of power by those smaller groups of shareholders, particularly where we have small groups of large shareholders and then some amount of small shareholders. The large shareholders may well abuse their power. Lastly, just thinking about international codes when it comes to corporate governance. The OECD principles were set out for multiple jurisdictions, so the Organisation on Economic Cooperation and Development, and this just set out good practice for management. So it's just another corporate governance code. It's much like the UK corporate governance code. It covers a framework for governance, it covers shareholder rights, the treatment of shareholders, stakeholders, and disclosures and board structure. Again, we have the ICGN, and that's the International Corporate Governance Network, and the objectives of it were to set out the investors' interests when it comes to corporate governance, to make sure that there's good corporate governance for listed companies, and to set out international principles that everyone should implement. So those are some of the different approaches to corporate governance.